Hello and welcome to this video on government-led strategies for growth and development. So in this video, we're going to look at a range of strategies the government might use to promote growth and development within their country. So there are a vast number of strategies that a government might consider in order to promote development and increase the rate of economic growth. On the board, we have some here that we can look at. But we're going to focus on interventionist government-led strategies. So these are similar to the interventionist supply-side policies that we spoke about last year. So an interventionist policy is one where there is an active role for the government to stimulate economic growth. As always with an interventionist policy, we have to bear in mind some potential drawbacks like the opportunity cost issue and the value for money. Particularly when we apply to developing countries, we also have to think about the quality of governance, the quality of politicians and the decision making, and potentially the issue of corruption. So our first interventionist strategy is the development of human capital. So poor education and low school enrollment is correlated with lower development. Governments may invest in education and training to improve the level of human capital. This will increase the productive potential of the economy and raise its ability to move up to higher value-added products. It may also attract FDI from foreign multinationals. However, there is a long payoff time with investing in schooling and education, and also we must ensure quality. Sometimes there is a resistance from family in developing countries to education because given the level of poverty, they would rather have their children helping them out trying to earn money at home. The second measure is a protectionism or protectionist approach. So reducing imports may create a more diversified economy and can lead to a process of industrialization. So looking at the Lewis model we mentioned previously. However, again, introducing things like tariffs, we have the consumer welfare argument. This may promote inefficiency in domestic producers. How does the government know which industries should we be backing if we're thinking about perhaps a subsidy? And there's always the risk of retaliation. The third approach is an interventionist approach in terms of the exchange rate to try and operate a managed exchange rate. So many developing country governments try to prop up their currency value to maintain a higher value. This reduces the cost of imported energy, for example, oil and capital goods. And energy and capital goods may be important for future economic growth, so they want to maintain a strong exchange rate in order to make this affordable for the people within their country. However, managing the exchange rate does increase the risk of a speculative attack. So selling and selling and selling, hoping that the currency will devalue by speculative traders. Reduces export attractiveness and may also lead to indebtedness. The fourth strategy the government may try and do is to develop infrastructure. This little chart on the right hand side shows you that there's a large potential infrastructure requirement, particularly in Asia and some African countries as well there, the light green. So this is building roads, railways, electricity, gas, broadband, ports, etc. And these are key assets for society to function and economic activity to take place. However, in terms of evaluation, long construction times, expensive, how do we finance these projects? And we have the risk of perhaps what's known as white elephants, projects that actually are not useful, not effective. A fifth thing the government may do is introduce joint venture requirements. So joint ventures when two businesses work together on a specific project or set up a special company between them. The government may require any foreign multinational companies operating in their market to partner with a domestic company through a joint venture. The local partner here may gain skills and expertise from the multinational providing the FDI. However, multinational companies often repatriate the profits and have more experience of negotiating deals. They may also be supported by their domestic government. An example in China was Jaguar Land Rover have a joint venture with the local Chinese car manufacturer Chery. Lastly, the government may consider doing a buffer stock scheme, and this is in order to smooth out fluctuations in price. This enables farmers to have a more secure income so they can save and invest. However, it is costly to run. So essentially what the government do is they introduce a maximum price and a minimum price for stocks. So when we have a good harvest and it looks like the price is going to fall too low, the government buy up the surplus to keep the price within this range at the minimum price. When we have a poor harvest and the price looks like it's going to rise too high, the government sells some of their surplus to keep the price lower at this maximum price P1. So they can effectively keep the price between P1 and P2 by buying and selling surplus stocks. So in this video, we've looked at a range of different government strategies that could be used to promote growth and development. That's it. Thanks very much for listening.